Okay, good evening. This is Professor Mayer, and this is our fifth chat session. And this is our second chat session specifically related to our Chapter 19 in the session that we're focusing on, which is stockholder equity. Last time that we talked specifically about earnings per share calculations. Now we're going to interject some issues related to stock options and how these are actually accounted for in our financial statements. And when we talk about stock options, we're talking about stock options that are issued to executives and other employees in their employee process. So it's going to be an interesting discussion, and we will start this discussion right away. We're going to focus on some very specific exercises, and these exercises are going to come from Chapter 19. If we do have some time, we're going to focus on a couple of other exercises that are from the other book, the prior book. So what we're looking at here is we have on January 1st, 2016, VKI awarded restricted stock units, or we're calling them RSUs, representing 12 million shares of its $1 par value common shares to key personnel, subject to forfeiture if the employment is terminated within the next 3 years. So just kind of visualize what's taking place is we're issuing these shares. This is not a stock option where they have the ability to buy. We're just simply giving these shares to these employees at the end of the 3-year period. So this is a little bit different than some of the other assignments that we're going to be looking at. In this case, we are giving shares. We are not giving them the option to buy these shares. There's a distinction there that we'll get into later on, but in this case we are simply giving these shares. So you notice that at this point in time, these shares have a market value of $2.50. So that $2.50 is the amount that we're actually dealing with, and it's the market price when we developed this this restrictive stock unit program. Continuing on here, what we want to find out is we want to find out the total compensation for these reserve share units. We want to prepare the proper journal entries as of January 1st, 2016. And then you notice that we are going to do a year-end journal entry. Well, we'll just do the year-end journal entry for the first year, but what we want to really focus on is what's taking place at the very end. So in the first case is what we want to determine is the total value. So you notice in this situation is that what we have is we have 12 million shares granted, and the fair value at the time of granting these shares is $2.50 per share. Therefore, the value of what we're offering is $30 million. When we issue the shares, or when we grant these shares to be paid 3 years later, there is no journal entry. But what we do have is we have a journal entry at the end of each year. You notice here that at the end of 2016, which is the first year, we have a debit to compensation expense of $10 million. So it's very important that we understand that given the fact that these $30 million worth of stock is there to incentivize employees, key personnel, for a 3-year period, that what we're doing is we are distributing the cost of this over the 3-year period. So what we have here is we have a compensation expense of $10 million. The credit is going to go to paid-in capital restricted stock of $10 million. So notice this, it's paid-in capital restricted stock, $10 million. And that is the journal entry that's going to take place for the 3 years. Then at the end, you notice here that we are eliminating the paid-in capital restrictive stock of $30 million, and we then increase common stock at par value for $12 million, and then the excess of $18 million is going to paid-in capital in excess of par. So once we've paid this and we've issued the stock, there's no distinction in the balance sheet related to what is the restrictive stock that was paid and the other common stock. So everything then moves over to common stock and paid in capital. And again, we are paying this key personnel $1 par value stock, and we're paying it at the end of the 3 years. Very important to understand that every year we are reporting a compensation expense. So that's going to be a period expense that's coming through the income statement as part of our expense related to the employees of $10 million. And then we are then moving that over to the restrictive stock. Once we pay the stock, then we move it over to common stock and paid in capital. So let's look at the next exercise. Magnet Optical Corporation offers a variety of share-based compensation plans to employees. Under its restrictive stock award plan, the company on January 1st, 2016 grants 4 million of its $1 par value shares to various division managers. These shares are subject to forfeiture if employment is terminated within the 3-year period. The common shares have a market value of $22.50 per share on the grant date. Now you notice in the other example, as we'll see here, is that we're using the market price based upon the point in time when the shares are offered, not when they're paid. So we're not really considering what the market value of the stock is when they're paying it. We're considering what the market value is when we issue the stock purchase plan. So we want to determine the total compensation, prepare the original journal entry, prepare the appropriate journal entry for the end of the year. And then the issue becomes is, let's say we expect a 10% forfeiture rate on the restrictive stock prior to vesting. Determine the total compensation expense. The forfeiture is actually an important piece of this because, again, keep in mind that what we're doing is we are using this from the perspective of encouraging employees to stay around for an extended period of time. So this is a 3-year period. So they're committing for 3 years before they're going to get paid. Now, if they leave early for whatever reason, maybe they found a better job, maybe they got terminated for cause, or maybe who knows what happened to them. But if they didn't last the 3 years, they get nothing. We need to account for that. And what we're doing is we're accounting for that based upon an estimate, and we're expecting a 10% forfeiture rate. So the first thing is we are doing the calculation of what is the value of these restrictive shares. So it's 4 million shares, and we're multiplying this by the market value at the time the program was initiated. So the market value at the time the program was initiated was $22.50. Therefore, this is a $90 million grant. When we actually issue this grant, we have no journal entry on January 1st, 2016. And again, keep in mind that this is a 3-year program. So a 3-year program is $90 million. We're issuing this over a 3-year period, so it's going to be, it's not $300,000, it's going to be $30 million each year. We are dividing the $90 million by 3 years, and the compensation expense, which is a period expense, goes to the income statement. The credit is going to go to paid in capital restrictive stock that we see here. Suppose that Magnet expects a 10% forfeiture rate on the shares. So what we're basically saying is that we are actually going to pay 90% of this, which is $81 million as opposed to $90 million. If we're expecting this, essentially then what we would be doing is we would simply be doing the $81 million divided by 3 as opposed to the $90 million divided by 3. In the next problem, what we have is we have American Optical Corporation provides a variety of share-based compensation plans to its employees. Under its executive stock option plan, the company grants options. Now you notice here that we are granting options. We're not issuing stock. So we're granting options on January 1st, 2016 that permit, keyword here is permit, executives to acquire 4 million of the company's $1 par value common stock within the next 5 years, but not before December 31st, 2017, the vesting date. The exercise price is the market price of the shares on the grant date, which is $14 per share. The fair value of the 4 million options is estimated by an appropriate option pricing model is $3 per option. No forfeitures are anticipated. Ignore taxes. So let's kind of walk through this. So in this case, what we're saying is we are giving the executives the option to buy the stock for $14 a share. So the expense then is not related to what we are issuing in terms of stock, but what we're actually giving. And what we're giving is we're giving these executives an option to buy. Well, if you've taken a finance class or even an advanced accounting where we talk about hedges and so forth, we talk about options. Well, an option has an intrinsic value. This intrinsic value is based upon what we're actually going to buy or sell. In this case, we're going to buy. So the intrinsic value is the difference between the strike price and the market price. Here they're the same thing. But then the other issue is essentially the time component related to risk and a couple of other things. We use basically the Black-Scholes method in terms of option pricing. We don't have to do those calculations. It's given for us, but just keep in mind that in the background, there is a method to price these options. The method to price these options prices these options at $3 per option. So the issue becomes is what is the total compensation pertaining to these options? So you notice that we're not doing the compensation pertaining to the stock, but we're doing the compensation pertaining to the options. So we're going to prepare journal entries, and we're going to do the appropriate entries related to compensation expense as of 2013 or 2016 and 2017. What we're looking at here is we're looking at the total compensation pertaining to the options. So the options are 4 million granted times $3. So 4 times 3 is 12, so we're talking about $12 million. $12 million essentially represents the value of the options at the time the program was initiated. There is no journal entry at the time of the initiation, but at the end of the year is we are recording half of this as a compensation expense, and the credit is going to go to paid in capital restricted stock. Now keep in mind, this is very important, is that the program is set up where it essentially facilitates the encouragement of these executives over a 2-year period. Therefore, we are dividing this expense into 2 years. So I have the compensation expense of $2 million in 2016 and $2 million in 2017. Okay, so the issue becomes is what happens at that point? Well, what happens at that point when they, let's just kind of look through it. So the appropriate, actually we'll talk about this with another problem. There's 2 options, one of which is they may exercise the option. They would exercise the option if in fact the market price is greater than the $14 per share, or these options may prove to be valueless because the market price is less than $14. So those are the 2 issues that we need to contend with, and in fact we will talk about those in the next couple of slides. So exercise 19.7, Walters Audio Visual offers an incentive stock option plan to its regional managers. On January 1st, the options were granted for 40 million $1 par value common stock. The exercise price is the market price on the grant date, which is $8 per share. So again, the exercise price on the option is $8 and the market price is $8. Options cannot be exercised prior to January 1st, 2018 and expire December 31st, 2022. The value, fair value of the 40 million options estimated by an appropriate option pricing model is $1 per option. Okay, so we're talking 40 million shares of stock and we have an option related to this. This option is $1 per option. Total compensation, and prepare the appropriate journal entry for December 31st, 2016. Prepare 2017. Prepare an appropriate journal entry to record the exercise of 75% of the options on March 2nd, when the market price is $9 per share, and then prepare the appropriate journal entry on December 31st when the options that have been vested expire without being exercised. Okay, so this is what we're talking about here. So again, keep in mind that the original price, the strike price, was $8. Market price went to $9. Therefore, there is value in the option. Well, we need to account for this. Then the next piece becomes is what happens, let's say it went to $9, 75% of the people were smart enough to know it's time to exercise the option and get out of the market. 25% of the people decided to hold. They knew the market was going to go up. Unfortunately, the market didn't go up, it went down. Therefore, there was no value in the option. So again, if the market price went below $8, there's absolutely no reason, no legitimate reason to exercise these options. So let's walk through this. I think we'll find this kind of interesting. So it's $1 per option, and one option gives you the option to buy one share of stock, and we're talking about 40 million shares. Therefore, the value is $40 million. This is a 2-year plan. So you notice that the 2 years is we record $20 million in compensation expense, income statement item, part of our payroll expenditures, and the equity account is what we call paid-in capital stock options. Compensation expense for 2017, $20 million. We increase our paid-in capital stock options of $20 million. Our paid-in capital stock options at the end of this period is $40 million. What happens now is we exercise these options. We exercise these options basically 3/4 of them. So 3/4 of them paid-in capital stock options. Well, what we're saying here is for them to exercise the option, they have to buy the stock. What are they going to buy the stock for? At $8 per share. So what we see here, very, very important in terms of understanding what's taking place. So what's taking place is we have paid-in capital stock options. What is that? Sorry about my squiggly lines. That is 75% of the $40 million in stock options. We said that we exercise stock options. Well, how do you exercise stock options? You buy the stock. What do you buy the stock at? Well, you buy the stock at $8 per share. So we have the $8 per share here, and we are exercising it for $30 million. Therefore, we have $240 million. The company is receiving $240 million. The company has a debit to paid-in capital of $30 million. And over here, we then increase common stock by the par value. The remainder is going to paid-in capital in excess of par. And you notice this, very important, is the market price is irrelevant. It's irrelevant in terms of the calculation, but it's relevant from the perspective that the only reason that someone would exercise the option is because the market value has gone beyond the strike price in the option. So let's go to the next slide and see what takes place here. 30 million shares is going to our common stock and paid in capital. So let's look at the next problem. In order to encourage employee ownership of the company's $1 par value common stock, Washington Distribution permits any of its employees to buy shares directly from the company through payroll deduction. There is no brokerage fee, and shares can be purchased at a 15% discount. During March, employees purchased 50,000 shares at a time when the market price of the shares was $12 per share. Prepare the appropriate journal entry, and let's see what's taking place over here. So what we have here, we are receiving cash of $510,000 because these employees are paying this, and they're paying the market price of $12 per share. They bought 50,000 shares, and they're getting a 15% discount. So the options are there. They have the option to exercise the stock between January 1st, 2018 and December 31st, 2022. 75% of the people exercised this option when the stock price was $9 per share. And the issue becomes is why did they do it and the rest of the people didn't do it? Well, you have the option, but you don't actually have to do it. And chances are the reason they exercised it was because they believed that the market price would actually increase. Well, if they believe the market price would actually increase, then theoretically there would be more value. But in any event, the market price did not increase. So the market price did not increase is they forfeited this, and essentially what would stay on the balance sheet would be this account, which would be the paid in capital stock options. So that's what's taking place. So in terms of this is actually kind of interesting. If everybody has the ability to buy the stock, what we see here in exercise 19.9 would not be considered a compensation plan. They're getting a discount, but they're not getting an overwhelming discount, and everybody's getting it. Therefore, there's no compensation expense related to this. In exercise 19.9, everything is going to go to the equity section. So you notice that there is no transaction that has compensation expense. And the reason, because everybody can do it, and the discount is not significant related to this option or this opportunity to buy. Okay, let's look at this exercise here. We'll see how many more exercises we got. I think we have more exercises than time allotted, but that's okay. On November 1st, 2014, Colombo Company adopted a stock option plan that granted options to key executives to purchase 30,000 shares of the company's $10 par value common stock. Options were granted on January 2nd, 2015, and were exercisable 2 years after that date. The grantee was still an employee of the company. The options expired 6 years from the date of grant. The option price was set at $40, and the fair value of the pricing model determines total compensation expense to be $450. How we get to the $450 essentially goes beyond the scope of this class, because that entails calculating the option price using this Black-Scholes method, which gets a little complicated. We've taken risk and all those things. We're not interested in that. We're looking at this from a transactional perspective. So this is a 2-year plan. Total compensation expense specifically related to the options was $450,000. All the options were exercised during 2017, 20,000 on January 3rd when the market price was 67, and 10,000 when the market price was 77,000. Prepare the journal entries for 2015, 16, and 17. Assume that employees performed services equal in 2015 and 16. So what we're saying is that this is a compensation expense that is equal in the 2-year period. And again, compensation expense is an expense that is an income statement item the paid-in capital stock options goes directly to the equity section and essentially is a holding that is eliminated when the options are actually exercised. So $225,000 each year. That's what we're looking at. 20,000 of these options were exercised on January 3rd. What we have is we have cash at $40 per share. $40 per share times $20,000 is $800,000. The debit to the paid-in capital stock option is essentially the 20,000 stock option certificates that were exercised, and then on the credit side, common stock is par value. Any 20,000 shares times $10. Anything in excess is going to paid-in capital in excess of par. May 1st is we're exercising the 10,000 shares times $40. That's the value of the strike price of the option. That's $400,000. The paid-in capital common stock options is the $150,000, and then it's either going to common stock or the paid-in capital in excess of par. And again, you notice that neither of these transactions takes into account the market value. The market value only means something because the market value is greater than the strike price. Therefore, the person will actually exercise the option. In this case, everybody exercised the options. Let's look at the next problem. This is January 1st, 2015. Titania granted stock options to officers and key employees for purchase of 20,000 shares of the company's $10 common stock at $25 per share. The options were exercisable within a 5-year period beginning January 1st, 2017 by guarantees still in the employ of the company and expiring on December 31st, 2021. The service period for this award is 2 years. Assume that the fair value option pricing model determines total compensation expense to be $350,000. So we're looking at a stock option that creates value for a multi-year period, and we're looking for this. So what we have is in 2016, 2,000 options were terminated when the employee resigned. The market price of the common stock was $35. And then on March 31st, 2017, 12,000 options were exercised when the market price of the common share was $40 per share. So let's look at these journal entries. So this is a option that creates value over a 2-year period. And again, it's $350,000 divided by 2, $175,000 for each year. Compensation expense debit. The credit is paid-in capital stock option. What we're looking at here on December 31st, 2016, we have the paid-in capital compensation expense of $157,500, paid-in capital options $157,500, and what we're looking for is to recognize the compensation expense for 2016. So what we're looking at here is it's the $350,000 times a half, so it's $175,000, and then we are multiplying this by the factor of 18,000 divided by 20,000. Let's make sure we understand where that number is coming from. So basically what we're looking at here, in 2016, 2,000 options were terminated. Therefore, in 2016, the actual compensation expense is going to be less. Okay? So the first year, 2016, we have the compensation expense, $175, paid-in capital, $175. April 16th, 2,000 shares that were terminated, and the 2,000 shares that were terminated is going to be a credit to compensation expense. And then what we have on December 16th, December 31st, 2016, not half, but a little less than half. It's 18,000 shares divided by the total of 20,000 shares, so the compensation expense is less for 2016, $157,500, and paid-in capital, $157,500. Exercising of these options of 12,000 shares, and the exercise price is $25 per share. The market price we're not interested in. The paid-in capital is the amount that of the paid-in capital for the stock options that we are eliminating, and these two accounts then go to common stock and paid-in capital in excess of par. So we note here that there are 6,000 options unexercised as of 3/31/2017. 20,000 minus 2,000. The 2,000 were the items that were terminated because people were terminated, and then what we exercised was the 12,000 options. So the takeaway on this one is that the eliminating of the options because of the resignation of the employees reduces our paid-in capital stock options and also reduces our compensation expense. Ultimately, when these are exercised, they're exercised not at the market value, but they're exercised at the strike price. That's the amount of cash that we receive. We debit the number of shares that are, number of options that are held in the paid-in capital stock options, and then that amount is distributed to common stock based upon par value and our paid-in capital in excess of par. So I think these are the problems that we want to go through tonight. I thank you very much for your time, and we will talk to you in 2 weeks. And if you do have any questions, let me know. Okay? Okay, great. Okay, thanks a lot.